Welcome to the Real Free News Podcast. Today, large asset managers use coordinated proxy votes from index funds to control corporate boards, executives, strategy, and industry behavior without majority ownership. A small number of asset management firms have acquired decisive influence over thousands of public companies by systematically accumulating and coordinating proxy votes that typically range between 25 and 35% of outstanding shares. This practice, known as boardroom capture or proxy voting power concentration, allows these firms to determine the composition of corporate boards and, through them, the selection of executives, the approval of compensation structures, and the direction of corporate strategy without ever purchasing majority economic ownership. The mechanism relies on legal authority granted to the asset manager to vote shares held in index funds and ETFs on behalf of millions of underlying investors. The decisive threshold is far lower than 51% because shareholder meeting turnout rarely exceeds 85%, and many institutional holders follow the recommendations of the largest voting blocs. A coordinated 25 to 35% position therefore functions as effective control in director elections, compensation referendums, and major governance proposals. Boards that anticipate opposition from these blocs routinely adjust policies in private engagements to avoid public defeat, creating a pattern of preemptive compliance that rarely appears in proxy statements. This arrangement represents a structural abuse of concentrated proxy authority rather than traditional ownership. The same stewardship teams apply uniform voting templates across unrelated companies and industries, producing widespread uniformity in governance practices, executive incentives, capital allocation, and public positioning. The following sections examine the specific strategies that enable this outcome and the systemic consequences that follow. Part 1. The strategy of minority bloc discipline and preemptive board compliance. The primary strategy of boardroom capture is the maintenance of a disciplined voting bloc that rarely falls below 25% in large-cap companies. Because the largest asset managers appear simultaneously as the top 3 or 4 shareholders in nearly every S&P 500 constituent, their combined vote is almost always outcome determinative in contested matters. Director elections, once pro forma, have become the leverage point. A credible threat to withhold support from an incumbent slate compels boards to negotiate changes long before the annual meeting. Private engagement has replaced public proxy fights as the preferred enforcement mechanism. Stewardship teams schedule closed-door meetings with management and independent directors to communicate voting intentions on compensation design, climate-related disclosures, diversity metrics, or merger policy. Boards that incorporate the requested modifications receive full voting support. Those that resist face coordinated withhold campaigns that are costly in reputation and almost impossible to overcome given the size of the bloc. This dynamic creates a systematic bias toward compliance with the preferences of the concentrated proxy holders. The strategy extends horizontally across industries. Because the same voting bloc is present in every significant competitor within a sector, identical governance standards are imposed simultaneously on all major players. Pricing behavior, capacity decisions, lending criteria, and wage policies therefore exhibit convergence that cannot be explained by market forces alone. The abuse lies in the use of minority proxy power to achieve outcomes that resemble coordinated industry conduct without violating literal antitrust prohibitions. Part 2. Cross-ownership and revenue recycling as entrenchment strategies. A second strategy that protects and expands proxy voting concentration is the dense web of cross-ownership among the dominant asset managers themselves. Each major firm is typically among the largest shareholders of the others, creating mutual interest in avoiding adversarial voting. A challenge to another manager's governance preferences would indirectly damage the challenger's own largest investors, producing strong disincentives for independent action. Revenue recycling further entrenches the structure. Management fees and securities lending income are reinvested into the same universe of large-cap stocks, continuously increasing relative voting weight without external capital deployment. Banking relationships reinforce the loop. Major banks serve as custodians and counterparties for securities lending, while the asset managers remain among the largest shareholders in those banks. This symbiosis generates mutual revenue streams and additional alignment against disruptive proxy contests. The combined effect is a partially closed system in which ordinary index fund inflows and internal cash flows automatically augment proxy control year after year. Market declines accelerate the process because new contributions purchase additional voting power at depressed prices. The strategy is entirely legal yet produces progressive concentration that no single participant needs to orchestrate consciously. Part 3. Industry-wide uniformity and cultural standardization as predictable abuses. One of the most visible abuses of proxy voting concentration is the rapid emergence of industry-wide uniformity in governance and strategy. When the same voting bloc can impose parallel compensation structures, climate commitments, or diversity targets on every significant competitor simultaneously, independent strategic differentiation becomes difficult to sustain. Empirical patterns of higher consumer prices, reduced output, and slower wage growth in highly concentrated sectors are consistent with the exercise of coordinated governance pressure. Cultural and political standardization represents another systematic abuse. Corporate mission statements, employee resource policies, and public advocacy positions now display remarkable similarity across firms that once maintained distinct identities. Boards adopt these positions not because of internal conviction but because resistance risks defeat in director elections or compensation votes controlled by the decisive proxy bloc. The result is a homogenization of corporate speech and behavior that originates from a handful of stewardship centers rather than from millions of underlying shareholders. Mergers and major capital allocation decisions fall under the same influence. Asset managers routinely communicate approval or opposition to proposed transactions well in advance, effectively functioning as gatekeepers for structural change in the corporate landscape. The abuse consists in the private exercise of public company voting power to shape outcomes that affect competition, employment, and consumer welfare far beyond the legitimate scope of minority shareholding. Part 4. The abuse embedded in retail investor inflows and asymmetric outcomes. The most pervasive abuse of proxy voting concentration is its dependence on continuous retail investor inflows that investors themselves neither understand nor authorize for governance purposes. Individuals allocate savings to low-cost index products because of superior historical returns, unwittingly expanding the very voting bloc that uses the shares to impose uniformity and extract rents from the real economy. The costs of this arrangement are externalized onto consumers and workers in the form of higher prices, reduced choice, and slower wage growth, while portfolio statements reflect only the financial return. The asymmetry is compounded by the fact that market downturns allow the concentrated bloc to increase its relative control at bargain prices while ordinary investors bear genuine losses. The structure thus converts dispersed household savings into permanent, unaccountable governance authority. Because the system delivers competitive compounded returns as long as equity markets rise on average, the inflow cycle continues uninterrupted. Each new participant repeats the same decision, further entrenching the proxy voting oligopoly. The abuse is structural. Rational individual behavior aggregates into collective disempowerment through a mechanism that appears transparent and benign. Conclusion: who really runs S&P 500 companies? Proxy voting power concentration has produced a form of boardroom capture that operates through legal strategies of block discipline, cross-ownership, revenue recycling, and preemptive board compliance. The result is effective control over thousands of companies by a handful of asset managers who never purchase majority economic stakes or assume operational responsibility. These firms do not need to own factories, stores, or intellectual property. They only need to maintain a reliable 25 to 35% voting bloc that no board can safely ignore. The chain of authority is complete. The bloc determines who sits on the board selects and compensates the executive team, and the executive team executes the strategy that aligns with the preferences signaled by the bloc. In practice, this means that a few dozen stewardship professionals in Manhattan, Malvern, and Boston now exercise more day-to-day influence over corporate America than any traditional owner ever could without spending hundreds of billions of dollars on control premiums. The abuses are systemic rather than episodic. Industry-wide uniformity in pricing and strategy, cultural and political homogenization, gatekeeping of structural transactions, and the externalization of costs onto consumers and workers while returns accrue to the voting intermediaries. These outcomes flow directly from the concentration of proxy authority in few hands. When the same voting guidelines are applied simultaneously to every significant competitor in a sector, competition on price, innovation, wages, or risk-taking is quietly dampened. Consumers pay higher prices, workers receive slower wage growth, and product variety contracts, yet none of these effects appear on the quarterly statements of the index fund investors whose shares made the votes possible. The cultural standardization is equally pervasive. Companies that once competed on brand identity now adopt near-identical language on social issues because deviation risks a withheld vote from the decisive bloc. The abuse is not that any single vote is illegal. It is that the cumulative effect of thousands of parallel votes, cast by the same small group of institutions, produces outcomes indistinguishable from collusion while remaining technically compliant with existing securities and antitrust rules. The arrangement persists because it is embedded in the dominant retail investment vehicle of the era. Low-cost index funds and ETFs remain the default recommendation of financial advisors, retirement plans, and robo-advisors precisely because they have delivered superior risk-adjusted returns for most investors over long periods. Each new contribution from a 401k, IRA, or brokerage account automatically purchases additional shares in the same concentrated universe of large-cap companies, thereby increasing the relative voting power of the same asset managers quarter after quarter. Market downturns accelerate the process rather than threatening it. The same dollar buys more shares and therefore more votes when prices are low. The system is self-funding and self-reinforcing. Ordinary household savings are converted into permanent governance authority that the savers never intended to delegate and cannot realistically retract without abandoning the investment strategy universally described as prudent. Boardroom capture through proxy voting concentration thus illustrates a profound structural distortion. The more faithfully ordinary investors follow conventional financial advice, the more completely they cede governance authority over the companies they notionally own. What appears to the individual as diversification and safety is, in aggregate, the quiet construction of one of the largest centralizations of economic power in modern history. The distortion is compounded by its invisibility. No single investor sees the cost on a statement, no single board admits to coercion, and no single vote violates securities law. Yet the combined effect is a transfer of control from millions of dispersed owners to a tiny oligopoly of proxy voters who face no meaningful accountability to the people whose capital they direct. Until the underlying legal framework treating proxy voting as an incidental fund management function is re-examined, the strategies and abuses described will continue to expand with every new dollar allocated to broad market index products. Thank you for listening to the Real Free News podcast. Be sure to like, share, subscribe, and tell us what you think in the comments section. Visit realfreenews.com for more Real Free News and check out the Real Free News store for real free food and gear. Remember to keep it real, free news, and we'll see you next time.